Welcome to this explainer, everyone. Today, we're diving right into the immediate economic aftermath of the recent ceasefire in the Middle East. When the headlines fade, the financial realities really set in. And we're looking at a truly fascinating paradox right now. We're going to unpack exactly what happened to the economies of Iran and the United States the literal moment the fighting stopped and tensions cooled off. It's kind of like a tale of two vastly different economic realities. And getting a handle on this divergence is absolutely crucial if we want to figure out where the broader global market is heading next. So, to really get the true impact of this geopolitical shift, we have to follow the money, right? We have to ask, how does a sudden pause in conflict actually hit global wallets, national budgets, and everyday realities on the ground? It's so easy to just focus on the high-level diplomacy, but the economic undercurrents? That's what actually dictates long-term stability. Uncovering these answers shows us just how hyper-connected our global economy is, and, honestly, how violently markets can react to the mere presence or absence of conflict. Let's start with the big picture, the macro view. Before we look at individual countries, we have to look at the immediate global reaction, which played out literally instantly in the energy markets. Investors, as you know, absolutely do not wait for official treaties to be signed. They price in the perceived risk in real time. And when we talk about global ripple effects, the energy sector is where those risk premiums vanish the absolute fastest the second a ceasefire is announced. During the active conflict, the sheer threat to the Strait of Hormuz, which is, of course, one of the world's most critical energy choke points, baked a massive risk premium right into oil prices. The market was basically bracing for worst-case supply chain disruptions. But the moment the ceasefire held and those crucial shipping routes remained secure, we watched that tension bubble completely pop. Prices came rapidly back down. The cause and effect relationship here is just undeniable, and it perfectly showcases exactly how fear, rather than actual supply deficits, can temporarily hijack global markets. Zooming in on the micro level, let's examine Iran's economy. A really fascinating dissonance has emerged here between newfound economic optimism and the harsh reality still on the ground. The end of the fighting naturally brought this immediate wave of hope for domestic relief. But as we're seeing play out in real time, hope is just the first step. Translating that temporary optimism into a functioning, thriving economy, well, that is an incredibly complex uphill battle. You can see Iran is currently caught in this intense economic tug-of-war. On one hand, there is undeniable immediate relief. We're talking an easing of restrictions on oil exports and a vital influx of foreign currency being injected by the central bank just to keep industries afloat. But that relief hits a brick wall of brutal headwinds. The economy is still grappling with incredibly stubborn inflation, lingering international sanctions that totally throttle standard trade, and a decimated infrastructure that's going to require massive, massive capital investment to fix. It's a highly precarious balancing act, to say the least. Ultimately, a ceasefire is a pause, guys, not a cure. While the end of fighting offers a much-needed breather, Iran's true long-term recovery is entirely dependent on two massive factors working in tandem: sustained, stable international relations, and deep internal economic reforms. Without both of those things structurally changing, the immediate financial relief we're seeing right now might just be a temporary band-aid rather than the actual bedrock for lasting growth. Now, let's pivot over to the United States and see how a very different economic machine reacted to the exact same geopolitical event. While Iran is navigating the immediate blast zone of the conflict, the U.S. experiences this from behind a heavily fortified economic shield. And ironically enough, unlike the oil shocks of the 1970s, where Middle East tensions would instantly cripple the American economy, today's U.S. market acts as a literal masterclass in modern insulation against global volatility. The U.S. response reveals a highly insulated economy. Thanks to massive domestic energy production, the American market essentially has this built-in shock absorber against sudden overseas volatility. By aggressively producing its own energy, the U.S. wasn't just protected from supply disruptions, it actually reaped a huge net positive. That subsequent global drop in oil prices translated directly to cheaper fuel costs for American consumers and businesses. So what was a crisis abroad simply became a cost-saving bonus at home. Crazy how that works, right? Synthesizing all of this is so vital because it proves that global economics isn't just a series of isolated events. It's a deeply interconnected system where a single pulled thread alters the entire fabric. So, let's pull all these moving parts together really quickly to solidify exactly where the global market stands right now.
We're left with a global landscape where easing tensions have successfully cooled energy markets, which granted Iran some critical, albeit limited relief against its severe economic headwinds. Meanwhile, the U.S. flexes its modern energy resilience, turning a global crisis into domestic savings. But the ultimate takeaway moving forward is this: global markets are currently holding their collective breath. They're waiting for concrete proof that this newfound stability is actually permanent before committing to any serious long-term investments.
And that brings us to a rather powerful reality. Lasting growth depends on stability, trade, and investor confidence. An end to conflict stops the immediate bleeding, sure, but true economic recovery, the kind that builds generational wealth and secures national futures, requires deep-rooted confidence. Investors need to know that stability is real. Trade routes need to be consistently secure. Growth is a very long game. So, as we wrap up this explainer, I want to leave you with this pivotal question to consider over the coming months. We've seen the immediate reactions, right? The rapid drop in oil prices, the currency injections in Iran, the lower fuel costs in the US. But the real test is still ahead. Will these reduced tensions actually translate into long-term economic progress for everyone involved? Or is this just a temporary lull in a historically volatile region? Keep a close eye on trade agreements and investor behavior, because that is exactly where you'll find the definitive answer. Thanks so much for joining me today to break this down.